when somebody tells you fancy, whatever their angle is in the street, that we're heading for a liquidity crisis or a liquidity tension, how do you respond to that?
Well, the way I would respond to it is look at what credit spreads have done this year. They have been as volatile as they've ever been, even more volatile than in 2009, which indicates to me that we've already seen a pretty big drawdown in liquidity. Now, the big fly there is that we have never seen central banks pump so much liquidity into a system before. So to say that we've already drawn it down, we're headed into a liquidity crisis, I think is a little bit premature. You have to throw out the playbook of prior hiking cycles and look forward to, is there still cash? Corporate balance sheets, money market funds, reverse repo. There's still a lot of cash in the system.
Buried in the FT article, Joshua's article, is a single sentence, like paragraph 42 or whatever, that says the solution is they're going to want more cash. All of a sudden, money isn't free anymore. And are you going to see essentially a global cash call within leveraged transactions? Because the way the math works out, you got to put more cash in?
Well, I think that we've already seen that to an extent. Even post-GFC, there's been a push to have more cash in transactions in general, just from kind of a credit fundamental standpoint. We've also seen that from corporate balance sheets. They've just been higher cash balances run rate for the past really 10 to 12 years. And that dynamic really amplified during the height of COVID, during the kind of cashing up that we saw. And then from an investor perspective, what we're hearing from clients is we're in cash, 20% cash. I mean, that cash has to go somewhere at some point.
So when people start to think about the appropriate level of credit spreads in a recession, do they need to rethink how wide we could go relative to previous downturns?
I do think so, and I think that the type of recession really matters. What are we talking about? Balance sheet recession, stagflation recession, hard landing recession. The different spread outcomes are very different in each type of those recessions. Hard landing, clearly a liquidity crisis. Spreads are gapping the widest level. Stagflation, they kind of remain near elevated levels, call it 200 basis points in IG, maybe 500 to 700 basis points in high yield. A balance sheet recession, that's a little bit trickier because that's going to be a little bit more idiosyncratic, see more dispersion across the market.
So where is the risk? And I ask this question because we've gone over this a few times. If we're unwinding 10 years of easy money, are we just going to say that finishes with 500 basis points of spread widening on high yield spreads? 500 basis points wide, is that it? You blow up a decade's worth of stimulus and that's all you've got?
It's really tricky right now. I think that what we've seen is a lot of cash going into the world of private credit, direct lending, leveraged loans. Those asset classes tend to be a little bit less liquid, which means you don't see the type of reactivity in terms of valuations that you've seen in, say, the investment grade market this year. So what we're looking at is the high yield CCC market has become very dislocated from the rest of the high yield market. I think that's kind of the critical point where you're seeing the tightening of financial conditions really wreak havoc on spreads, and the nice kind of compression that we've seen. CCCs have been kind of left out in the cold the past few weeks.
Let's go to the wheelhouse of CreditSights's, though, which is, okay, there's going to be these spread dynamics. Where's Bramall? Why isn't Bramall leading this conversation?
I told you, 3-day weekends to close out the year.
There's this dynamic in the spread market, and you're assuming that there's no defaults. I'm thinking Marty Fritzen 101, no rising defaults, whatever. To my theme, which is the great zombie roll-up of next year, is the CreditSights's world going to clear? Are there going to be troubled companies, troubled institutions that just clear, whether visibly or less visibly?
Yeah, absolutely. So we're seeing some really interesting pockets of risk really become very apparent in
Give us an example of this. I want a tangible CreditSights's example of this, giving away the secrets.
Healthcare is a great example. There are two very highly levered large companies, Community Health and Bausch, in the healthcare space in high yield. And the next 12 months are going to be absolutely pivotal for those two companies. They could likely contribute to a higher default rate, or also they could kind of fly by the skin of their teeth.
Okay, but this is the nitty-gritty of Winnie Cisar. We're going to do it right now without any aspersion of these two wonderful companies. The bottom line is they've got to restructure their debt, right?
The bottom line is at current kind of operating profiles, yes, there needs to be some sort of restructuring.
Who do they go to do that, and what is the constraints that they faced?
So the constraints are the reality that both of these companies have been kind of long-term challenges in the credit market. So investors are very familiar with the companies, the profiles, the management teams, all of these things. Now, the kind of beauty of it all is at kind of higher levels, private equity, private credit, they're
That's
looking.
just right where I wanted to go. She's reading my mind. Grandma would never do that. But if they go out and they go to a new investor, private equity, they want an equity kicker to make that get to 2024, right? Or
Yes.
2027.
That is reality, yes.